With everyone wondering where we're going economically, let's take a look at where we are now by the numbers. Based on final numbers from StatsCan, we saw a modest 0.1% increase in economic growth in October, the 9th consecutive month of growth. Overall, the economy is now 2.9% above pre-pandemic output. Some sectors are still in a deep hole, though. Arts and entertainment, 9% below pre-pandemic levels. Accommodations and food services, 5% below their February 2020 level. And air transportation, now at its highest level since pre-pandemic, still just 2/3 of what it once was. Meanwhile, we did benefit from strong oil and gas. Oil sands output fell in October, but is still 4% above Feb 2020 levels. And while growth has been spotty, inflation has definitely settled in at 6.8% in November, the 9th month above 6%, and a whopping 20 months above 3%. Meanwhile, jobs are plentiful. There are 630,000 more of them than before pandemic, keeping the unemployment rate at 5%, and a floor under wages, which rose 5.1% in December. That's 7 months in a row of hourly wage gains above 5%. Well, when it comes to the economy, the biggest questions for many are, will a serious recession come? And then, of course, might interest rates drop again? David Rosenberg is founder and president of Rosenberg Research. David, great to have you with us.
Well, thanks for having me on the show, Amanda.
So let's start with recession. And I want to start with a point that you've made that I think is worth kind of hanging on, which is we tend to think of the central banks trying to do the job of fighting inflation. And then when they're done, maybe we get some relief. They hold where we are and then rates come down. You made a point recently that actually after they stop raising rates, then the recession happens. So whatever pain we're going to experience is still ahead of us. What are you thinking about when it comes to what the recession might look like and when it might appear?
Right. Well, that's a very good point that you made. And generally, it's because of the policy lags between what the Fed and the Bank of Canada does and the impact it has down the road, because the economy resets in both directions to shifts in interest rates. The change in interest rates in one day doesn't have the impact the next day. It really takes place over time. So you're quite right that the recessions generally start within a year after the central banks start raising rates. And in the Bank of Canada, you've got Tiff Macklem has never compared himself openly to John Crow, but it's a very similar policy stance. And we've had Jay Powell consistently remind everybody that he's the modern day Paul Volcker. Well, we know what Paul Volcker did to inflation in the early 80s, and he destroyed the economy with back-to-back recessions. So look, I think that the best leading indicator is always the bond market. When you have a situation where short-term interest rates go above long-term interest rates, that's otherwise known as the inverted yield curve, it only happens 15% of the time in the past. 85% of the time, the yield curve is usually positively sloped. Mm-hmm. It's the best leading indicator for the economy that there is. And it's telling you the recession is starting right now.
Yes. Okay. We might see an economic slowdown. There are rate hikes we've already seen that have to work their way through the economy. Fair enough. But that because the job market is so tight, because relatively speaking, people built up savings, maybe this recession will feel different. What's your take on, if it does come, whether it'll feel bad, or will people keep their jobs for the most part, and therefore maybe it's less meaningful?
Well, two things about the excess savings fairy tale is that most of that money's already been spent, and whatever excess savings there are right now, it's really in the hands of richer folks who aren't really going to put that money to work. Maybe in the market, they're not going to put it to use in the real economy because they don't have to. For the people that spend in the economy, low and middle income households, that money's gone, Amanda. And the big point is that there is no more powerful influence on the economy than interest rates, right? The best economist of all time was a physics laureate, Nobel Prize winner, otherwise known as Albert Einstein, who famously said that the power of compound interest is the eighth wonder of the world. So we can talk excess savings. We can talk about the job market, which is a lagging indicator. The job market is always strong as the economy makes a transition from expansion to recession. Employment is always the last man standing. So that argument about the labor market didn't impress me in 2007. It didn't impress me in 2000. Didn't impress me in 1990. Yep. It didn't impress me in 1981. It's a lagging to coincident indicator. When there's no get out of jail free card with the extent of the monetary tightening that the central banks have put into the system, to do two things: to fight inflation, which is now in the rearview mirror, and also to defend their perceived loss of credibility. And the casualty is going to be the economy. I really don't understand why people it feels like they have to fight economists on the view that there's going to be a recession. Recessions are part of the business cycle.
Right.
There's been 11 of them since 1950, and most people behave as if they're unicorns. They don't exist. No, recessions are part of the cycle, and they tend to follow periods of aggressive central bank tightening. And this goes down as one of the most pernicious central bank tightening cycles in the post-World War II period. I'm not going to say embrace the recession. I'm saying prepare for it.
Right. And that's the key point here is we don't want to be caught off guard by it. So let's assume that history it hasn't changed and that we actually can learn from it. A recession may be headed our way. And with it, to your point, let's not assume a tight labor market protects us from job losses. We just haven't seen where they'll show up, what the damage is from a recession. Where does housing fit into all of this? Because that's a preoccupation for people, David, either people who want to be able to sell their homes at a huge profit or people who want to get into this housing market at a more affordable level. There's tension between those two camps, by the way, generational and otherwise. But do you think housing actually has yet further to fall than the 20-30% it's already come off of the peak?
Right. Well, housing is already in a recession, and it is the quintessential leading indicator, and it usually peaks before the recession, bottoms before the recession ends. In the United States, it's the same story. And it's not just volumes in terms of, say, sales and housing starts, but also the fact that both countries went into this downturn with enormous price bubbles. The Canadian housing price bubble was bigger than it was in the late 1980s, and we saw what John Crow did about that. And in the United States, the price bubble was actually bigger than it was when I was pounding my fist at the table when I was chief economist at Merrill Lynch. This price bubble is bigger now than it was back then. House prices are going down, and ultimately that will be very beneficial for all those people who couldn't afford to buy a home, those renters that were seeking to buy a home, but it was just too unaffordable. They'll be winners out of this. But the reality is that there are more homeowners in the economy than there are renters. And when their prized asset is going down in value, what that does is it depresses confidence, it depresses people's belief as to what their net worth really is, and they cut back on spending.
Right.
That's over and beyond everything else that's happening. But look, the reality is that housing, like the equity market, are the longest duration assets in the economy. In other words, they are the most interest sensitive. And the answer is that no. We're probably, I would say, in both countries, barely at the halfway mark of the housing aspect of it. Housing will be the first one that comes out of it later this year. But has housing, in terms of housing sales, housing starts, home prices, have they bottomed yet? I see no indication of that, neither Canada or the U.S.
So then let's finish, not a ton of time, but it may be amazing that we have not even necessarily seen the end of the rate increases. We're certainly seeing a plateau. Can we look down the road at rate cuts? Because to the first point here, if a recession's coming, we do see central banks responding. So people that are hanging on to their mortgage at this incredibly high level saying, I need this to go down. Is that in the future?
Yeah. Of course. Show me a recession where interest rates didn't come down. And they come down because credit demands go down. And so, yes, interest rates will come down, not immediately. The Bank of Canada has already stated that they're pretty well done. Jay Powell just indicated maybe one or two more hikes, then they're done. It means we're more than 90% of the way through. Even the ECB and the Bank of England are saying that they're getting close to the tail end of their rate cycles. But this is to finish off where we started off the show. What this past year was the pernicious interest rate increases. What happens next is the economy's response to those interest rate increases, because the economy resets with a lag to these interest rates. So what lies ahead is the recession. In recessions, interest rates go down. I expect they're going to go down by a lot, not immediately, because the central banks will be, it's once burned, twice shy. They're still nervous about inflation. But when rates do come down, and I expect this will be a story in the second half of the year, they're going to come down a lot. And if you have the liquidity and you have the savings and you're looking for a home, you're going to be one of the winners coming out of this.
There are always some winners. David, great to have you with us. Appreciate your time.
Pleasure. Take care.
David Rosenberg, founder and president of Rosenberg Research. Coming up, is Google anti-competitive? And is it just so useful we don't care? That's still ahead. But first, it's the end of an era again. Tom Brady announced on social media this week that he is retiring from football, and this time he means it. The most successful quarterback in NFL history, who captured the attention of fans of all types on and off the field, broke numerous records over his 23-year career, including in yards, passing, and touchdowns, but may also be remembered as the most monetized brand on the field and off. Brady's post-football gig includes a $375 million deal as a TV sports announcer. We're back after this.